Hey, this is Chris from StockSpot. Now, last year in December 2023, I shared on Livewire in a video that I'll share in the comment section below a few anti-consensus views I had on markets and how I thought that could play out over the next 12 months. I was saying that I was positive on gold as an asset that more people should include in their portfolios, but also that people had really fallen out of love with income generating assets and inflation protection assets, and that these are two asset groups that I thought would do well over the next 12 months. Flash forward to November 2024, and gold is up 34% over the last year in its best 12-month performance in 20 years. And our inflation protection portfolio and income portfolio have both done very well with returns of over 20%, led by real estate investment trusts, which have had a fantastic year, Australian bank shares, which have also performed very well, as well as infrastructure assets, which have had a great rebound. So they've had a fantastic year, and I certainly wouldn't predict such a strong year going forward. And absolutely, our recommendation to StockSpot clients is to not have a concentrated portfolio based on predictions, to make sure you're diversified across different asset classes. However, I am often asked what I think may happen in markets next year, so let's give it a crack. And I wanted to share this year my 3 anti-consensus views of what may happen in markets next year. My first one is around US shares. I think there is a lot of high expectations built in for the US share market going forward. I think the views of there being a no landing, which basically means we're not going to see a hard landing in the US, business positive policies coming from the Trump administration, but also a calming down of inflation and continual reduction in interest rates. All of these, I think, are bubbling to being really exciting for market participants in the US. But I think if any one of those 4 doesn't play out as expected, it could lead to a lot of short-term disappointment. And you could easily see a quick 15 or 20% fall in the US share market, which would surprise people next year. So that would be an anti-consensus call. I believe that US shares won't have the good year that they had this year. It also gives me more confidence to see all of those market strategists that last year weren't very positive on markets now are very positive. I think these strategists usually don't get it right, and so the fact that they are now bullish gives me more confidence that the US market may not have a great year in 2025. My second anti-consensus view would be around Chinese shares. They have been a horrible asset class to be investing in over the last 10 years. They've basically gone nowhere. There's been a lot of anti-business policies that international investors have been frightened off because of. However, I think the stimulus that's now coming into their economy, along with potentially people, feeling a level of resolve once Trump comes out with whatever he is proposing when it comes to tariffs, I think these may give confidence to people to invest in Chinese equities and more broadly emerging markets next year. And so I think these asset classes of emerging markets and Chinese shares will surprise people to the upside. They're also so unloved that I think people could be chasing their tails as they try and get exposure to these asset classes again in their portfolios in 2025. And my third view would be that I think that there will be a continual tug of war in expectations around interest rates and inflation. The current views are that interest rates can continue to be cut in Australia and the US. Certainly, if inflation rears its head again, that will change. Or conversely, if there's a recession that comes and surprises people, interest rates may need to get cut further. But that itself may then stoke the next wave of inflation to start soon after that. So I think there'll be a bit of whiplash when it comes to expectations around interest rates and inflation, both in Australia and the US. And that's going to lead to quite a lot of volatility in bond markets and share markets more broadly as people try and price short-term interest rates and inflation expectations. And they're my 3 views that are probably not widely held in markets, but I think could play out. What does it mean? Well, our view always for StockSpot clients is stay diversified, own a whole range of different asset classes. And if this does play out, what it will do is give the portfolio some great rebalancing opportunities throughout the year, because we'll be able to buy assets when they're discounted and rebalance out of assets that have performed well. Another great reason to stay diversified and not try and chase hot markets within each year.